Hello and welcome to this week's Australian Share Market Report. I'm Dale Gillam, Chief Analyst at Wealth Within. This week I'll be discussing what a stop loss is and why you should use one. I'll also cover the All Ordinaries Index and this week's stocks of interest that you, our viewers, have asked me to look at. Now if you're regular to this channel, welcome back, and if you're joining us for the first time, let me extend a big welcome to you. I'm sure by watching these videos you will gain some great insights and inspiration as to how you can confidently and profitably trade the stock market. And as always, if you have any topics that you want me to cover or you have any thoughts on this week's report, please comment below and be sure to subscribe to our channel to keep up to date. Also, before I get into the report, click the like button just below. All done? Great. So let's get into this week's report. One of the key criteria of astute investing, no matter what the investment may be, is to consider when and how you will take your profits. In other words, you need to consider your exit strategy. When it comes to the stock market, it's how you will apply your stop loss to protect your capital before you decide to invest. As many of you will have heard me say many times before, trading is about minimizing risk, not maximizing profits. Profits come from trading well, not just from attempting to pick the next big winner. It's been my experience that the majority of traders focus on profits with little to no regard for minimizing their risk. When I do public presentations, it's common for me to ask the audience if they use stop losses or have exit strategies, and every time I ask this, only around 10% of people put their hand up saying that they do. That's like driving towards a cliff and not knowing where the cliff is. In contrast, the most successful people in the market that I know consistently average a good return on their portfolio by minimizing their risk. That means they know when to get out. In fact, not being exposed to heavy losses is in itself one of the key principles to successful trading. I'll say that again. Not being exposed to heavy losses is in itself one of the key principles to successful trading. Now back to stop losses. What are they? Well, a stop loss is quite simply a price point which you commit to selling a security. It is used either to preserve capital when a recently entered trade turns against you, or to protect the profits you've gained on a winning trade. Now it's important that you decide on your exit strategy before you place a trade, as it is usually too late to do this when a stock is falling. It is also the worst time to do it. The reason for this is simply because your money's on the line. Now when your money's on the line, then the fear of losing is greatly amplified and you make emotional rather than rational decisions when it comes to holding or selling. Sound familiar to you? I find it's often the case that the trader struggles to admit once they have taken a position on a stock that it just did not do what they expected, or they've made a mistake. It is hard to be objective when you're losing your money unless you have a solid strategy and rules to follow. For those of you who have been on our website and you've looked at our courses, you will know that there is a 60-second trading assessment that you can take to assist you. Now, would it surprise you to learn that around 90% who fill out that survey tell us that they know how to buy, but they don't know how to sell? When I chat to these people, I find that whilst they say they know how to buy, 90% actually do not know how to do that either. Well, not in my book anyway. Just placing a trade with a broker is not knowing how to buy. Buying is about solid analysis, rules, and skills. And 90% of traders are lacking in these areas. But let's get back to selling. Knowing when to sell is the more important aspect of successful investing or trading. Learning this will dramatically change your outcomes by reducing your losses and increasing your profits. In fact, knowing when to sell will seriously add thousands of dollars into your bank account. So how do you calculate a stop loss? Well, when calculating an initial stop loss, you need to use the most recent price available to determine your potential buy price. Now this will generally be the closing price for the previous day, week, or month, depending on your strategy. Now it's critical that you calculate your stop loss before you buy. You do this so that you can work out the risk that you're willing to take with your money. When you calculate the loss you will suffer if the trade turns against you, this tells you what you are risking. And you may find that you do not want to buy the stock if that risk is too high. It just makes sense. After all, would you drive a car if you knew it did not have any brakes? It does not matter how fast or how flashy the car is or seems to be. Not having brakes means you're taking high risk. When it comes to actually setting the stop losses, there are a number of different strategies that you can consider. Let me say that setting stop losses on stocks can be challenging if you do not have solid trading rules for entry and exit. Because not having solid rules will mean you are inconsistent in your trading results. This then makes it hard to have anything that will generate consistent results, and you stay on the merry-go-round of the struggling, frustrated trader. Now back to stop losses. When setting an initial stop loss, as I mentioned earlier, what you are doing is limiting downside risk on any new trades entered. Given this, you need to have your stop loss close enough to your buy price to ensure you do not lose more than 2% of your total capital. You also need your stop loss far enough away from the price that the stock is trading at, so it has some room to move in case it falls for a short period of time after you buy it. The same rules apply for anything that you are trading. A huge and very, very common mistake that traders make is to set stop losses far too tight for fear of losing. When you do this, you end up getting the opposite result to what you've been trying to achieve. That is, you end up losing more money as you exit, only to find the stock turns around to rise again, and if you had stayed in the trade, you would have made some great profits. But what is too tight? Well, that depends on the market you're trading and your trading plan. Getting into this right now is not my intention, as it requires you to have a lot of knowledge around trading, trading techniques, and technical analysis. If being a great trader interests you, then have a look at our courses on our website. And in these, I will teach you what you need to know at whatever level you are right now. Now, to keep things in context today, I will share with you how to set an initial stop loss on a big blue chip stock. Stop losses for spec stocks are different, as they can be for other markets. When setting an initial stop loss on blue chip stocks, there are a couple of options that you have. The first is to set a percentage of your buy price. Now here I suggest a stop loss you set should be around about 10 to 15% below your buy price. Where or how tight you set it in that range will depend on the volatility of the stock, as this allows for minor fluctuations in the price as the stock settles into the trend. Setting your stop losses too tight, say 5% below your buy price, leaves very little room for the stock to move and will decrease your probability of a winning trade. In fact, most often than not, a stop loss this tight is a trade killer and not a profit maker. Alternatively, you can set the stop loss at a price point where you know with high probability that you may be wrong in your analysis. Now, when I say wrong in your analysis, it may be that the stock did not do what you expected, rather than you actually applying rules, techniques, or strategies wrong. That said, the majority of traders I meet just plain get their analysis wrong. Now here's a rule. I recommend calculating both stop losses and then using the one that gives you the least amount of loss. So let's look at how you set a percentage-based initial stop loss. Let's say you decide that you want to buy XYZ investment company because you believe it will rise in a nice long uptrend. The stock closed in its last day of trading at $1, and you want to purchase the stock when the market opens the next day. Your trading capital is $10,000 and you want to use 20% or $2,000 to purchase the stock, and you wish to set an initial stop loss of 15% below your buy price. Now your stop loss calculation would be the buy price, which is $1, multiplied by 15%, and that equals 15 cents. Therefore your stop loss is your buy price of $1 minus 15 cents, which equals 85 cents. Now once the stock closes 1 cent below your stop loss of 85 cents on any day, you would sell to protect your capital. Now there are variations on this that we teach our students depending on the stock or the market. Once you have your stop loss, And remembering you're doing this before you enter the trade, you know you need to convert this into the actual money or the trading capital you stand to lose if the trade goes south. Remember, you do not want to risk more than 2% of your total capital. Therefore, your calculation would be $2,000, which is your trading capital, multiplied by 15%, which equals $300, or the amount of potential loss you'll be exposing yourself to on this trade. You then divide $300 by $10,000, or your total capital, and multiply this by 100, which equals 3%. Now, if you take this trade using a 15% stop loss, you stand to lose 3% of your trading capital, which is above the allowable risk level of no more than 2% of your total capital. Therefore, this trade is representing an unacceptable risk. Consequently, you need to reduce your stop loss until you reduce your level of risk to 2% or below, which in this example would equate to a stop loss set at 10%. The second stop loss you would need to work out is the price point where you know with high probability that you are wrong in your analysis. This stop loss is determined using your entry rules. For example, if you bought when a stock crossed above a trend line, you would know your analysis was wrong if the stock traded back down below the lowest low immediately prior to the stock trading above the trend line. This is because a stock in an uptrend continually achieves higher lows or troughs, but when it makes a lower low, it suggests that the uptrend is failing, and so you should exit to protect your capital. For example, on the screen now you'll see the price is traded above a downtrend line on the chart, and there is 2 weekly closes above it. Now, this is a pretty standard buy signal. Now, whilst there are other analyses that you can and should apply to each and every trade you do to improve your probability of success, let's just keep things simple today and you decide to buy on 2 closes above the trend line. Now you can see after buying, price fell away and you would have exited at a 5.34% loss. Now if you'd used a percentage-based stop loss, you would lose 10 to 15%. So in this example, it makes sense to use the lowest low as the exit to the trade rather than a percentage stop loss of 15%. As this would enable you to exit the trade with the least amount of loss. Now, this does not work 100% of the time. You need to understand that nothing in trading ever does, but it works the majority of times. This is where traders constantly make big mistakes, as they tend to guess at rules and then expect them to be accurate 100% of the time. Now back to stop losses. Remember, once you actually purchase the stock, you need to recalculate the initial stop loss based on your actual buy price to ensure your stop loss is set at the right price point. Now, before I wrap this part of the report up, what I've gone through, I teach in my book, Accelerate Your Wealth. It's your money, your choice. So get out and get yourself a copy and review what I've just taken you through in much more detail. Also, if you're serious about trading well, then look at my courses. They really are a small price to pay for your success. So let's get into this week's stocks.
Please remember that this report is an educational tool, and as such, your personal circumstances have not been considered in the analysis of the compilation of shares included. The content of this report cannot be considered personal financial advice. If you have not done so before, pause the video and read the disclaimer on screen. We hope that you enjoy this week's report.
All right, guys, this week we got a lot of comments from you from our last video, so thank you very much. And also a few of you gave me some suggestions of topics, etc., that I can be doing in my next video. So really, thanks a lot for doing that, and thanks for all of those people, and especially those new to commenting. So you know, sometimes these sorts of things, you know, you can see the same people commenting over and over and over again and asking for stocks. But if you do need me to look at stocks or want me to look at stocks, if you've got any questions, you do need to type down below and ask me, because I'm really happy to help out and really make sure that you get some good information and you get your stocks looked at for yourself. Anyway, but I just want to look at, I've just got my printer didn't work today, so I've just got everything on my little iPad here, everything that people are asking about. So I'll just cover a couple before I get into a couple of stocks. So I've got Kim Lambden. Hi, Kim. How you doing? I think Kim's in Japan, they tell me. So hi to Japan. I love going to Japan. It's beautiful, especially the skiing. So she says, hi, Dale. I recently bought your book and enjoy your videos. Thanks very much. I'm just wondering if you could do a video on how to go about setting up and managing your own superannuation fund and the fees associated with that as compared to letting fund managers do it. We are going to be doing that. It's going to be a specific series that we'll actually do for you, Kim. I've already been chatting with Janine, who's my right-hand lady, I suppose. She's been with me pretty much the whole time, or Janine's been around me for over 20 years. So she's our senior analyst. She manages all the stocks and does all the analysis for the stocks in our managed account services where we're managing portfolios for people. So she does all that and handles that. Plus she makes me look good by giving me lots of research as well. So we will be doing that. So look out for that in the not too distant future. We will be doing it. There was a report out only, I think it was last week. I think it came out in Money Magazine or something out there on their website saying that the Productivity Commission said you need $1 million in a self-managed super fund to make it worthwhile as opposed to being in an industry super fund. And I thought that was the biggest load of BS I've ever heard in my life. Before I have a super fund, I know lots of people that do have a self-managed super fund. It costs bugger all to run if you get the right services behind you, and you'll absolutely cream the returns of all managed funds and managed super funds. So I think the industry wants you to give your money to them all of the time, and they keep coming up with research saying it's too costly, it's too hard, to everything else. But the best way to make more money for your retirement is in a self-managed super fund. Provision is you need to know what you're doing. So have a good read of the book, and that will help you understand what you need to do on the investing side of things. And if you want to take it a bit further, maybe our courses. But thanks for being a part of the channel. So Ramit, thanks Dale. Ramit was one I answered last week. Hi Dale. Thanks for covering my question this week. Live questions is a great idea. I understand you're a busy man, but may I suggest you have a live webinars as well? This will definitely help amateurs like myself. The book is great. Keep up the good work. Thanks, Ramit. We are going to be doing live streaming, as I briefly mentioned last week. That's where you're going to be able to do this, because I'm finding whilst this is great, I don't have a lot of time to sit there and answer questions and get into things in a lot more detail. That's going to be the live streaming sessions that we're going to have. We're going to be doing some tests this week, probably a bit more next week. So hopefully in a couple of weeks I'm going to be doing a live show. I think at this stage it's going to be 7 to 8 p.m. Wednesday nights. So you'll be able to log in live via YouTube, Facebook. I'm not 100% sure exactly. You'll be able to ask me questions live and I'll be able to give you answers. So it gives me a little bit more time. So it is coming. If you're looking about education in terms of how to trade, that sort of stuff, all of that sort of stuff's in my course. I won't be doing education in the detail that you needed in these sorts of videos, because it's just not something you can do in these sorts of videos. All I can do is give you a bit more information and a process and a little bit more sort of direction on the way to go. But watch out for the live shows. We've got Robert Freeman. Hi Dale, recently found your channel. Welcome Robert. Getting a lot of value out of your videos. Thank you very much for that. Very professional and lots of great mixing. Got great content, mixing this with reading The Intelligent Investor and Rule 1 Investing. Intelligent Investor is supposed to be a really good book. I've never read it myself. My question is always looking long-term here. Wouldn't it be a great time to invest in one or a few of the big four banks? They are taking a pummeling and seem to be at bargain prices. Welcome, Robert. As I said, I haven't read The Intelligent Investor or the other book. I haven't read either one of those. I'm a technical analyst. That's what I do. Whilst I do use fundamentals, The Intelligent Investor is where Buffett learnt from, basically, Benjamin Graham. Michael Abbott, he says, thanks Dale, I appreciate the time and effort you put into this. What's your opinion on the big four banks now the results of the Royal Commission has been released? I'm going to look at that in my stocks. I'll do that in a second. We'll do that. But first, what I'm going to do now is get into, hang on, there's one more here. Robert Russell said, what do you think would be the general effect of a Labor government on the ASX? I know franking credits likely out the window, but what about potential over several years? Also impressed with the short-term results of your picks for this year. Just to briefly answer Robert, thanks, welcome to the channel, Robert. Just to briefly answer Robert, talked a little bit about this, the Royal Commission, on a video I did, or an interview I did with Proactive Investor last week. I think it went up on Friday, I think it was, and I talked a bit about the bank, the Royal Commission, that sort of stuff, the banks themselves. right now it looks like the Labor government's going to get in. That scares me from a business point of view and a few other different points of view. But to me, it doesn't matter. I've gone through a lot of elections over my lifetime, and pretty much it doesn't change what I do, because what you do is up to you and how you manage things. Now, in terms of the stock market, you know, as terms of business, it's far better for business if we have a Liberal government from that point of view. But that said, they're a little bit more for the big end of town rather than small business. And small business is the lifeblood of the economy. We really do need to support that. If they take off, I mean, Labor's looking at the negative gearing and taking off some of the negative gearing things for property, that sort of stuff, and also obviously that franking credits. I think that franking credits is a bit of suicide if you ask my opinion. There's a lot of retirees rely on those franking credits as part of their income stream, so they're going to get a lot of backlash if they keep pushing it. I don't think they should be doing it. Same with the negative gearing aspect. Yeah, I can understand a little bit about what they're coming from, but if Labor gets in, we're going to pay higher taxes and they're going to spend a lot more money, and we're going to go more back into debt, which I don't think Australia can afford. Australia needs to get rid of the boat anchors. We've had a boat anchor for the last 10 years with the debt from the GFC, which was created pretty much simply by the Labor government, which they got rid of all the money we had in the, well, not all the money we had in the Future Fund, but they put us into huge debt, and it really didn't work that well. So, you know, what did we get out of it? So to me, we need to see a little bit more steadying the ship and a little bit more about business. If business is booming, everybody's got jobs, everybody's happy, the economy's great, and the stock market goes up. But as far as the stock market's going, if there's a Liberal government in or a Labor government in, it's not going to change where it is. You can't change the momentum because we drive the economy. And I call politicians the captain of the Titanic. And why I say that, or the government is like the captain of the Titanic, in terms of, we know the ship's going down, we know the momentum's going to happen. They just can tweak a few little things and make the band play a little bit longer so we feel a little bit better. And that's all they do within monetary and fiscal policy, is just to tweak a few little things so it's a little bit smoother. They slow it down or speed it up a little bit, but the direction is dictated by us. They don't control those sorts of things. So not a big issue to me. So let's get into the market and let's look at what the All Ords is actually doing. I'll put my glasses on. On your screen right now, you should be seeing, okay, I've got up the top 50 watch list, which is down the left-hand side here. So you can see returns of the last week. It's pretty phenomenal last week, the market, after the Royal Commission happened. And what we've got to look at is whether this is a suckers rally or whether this is long-term sustainable. I still think the market is bullish and I still think we're going to go good. Banks, I'm not 100% convinced of yet, but we'll look at those in a minute. Right-hand side of your screen is what they call a relative rotation graph. I won't really get into that with you because it'll just start spinning your head about what it does and how I use all that in my analysis. But let me go to the weekly chart on the All Ordinaries Index. Here you can see last week's bar, which is the week ending the 8th of February. We closed at 6136 after opening at 5935. So as you can see there, the range was 247 points and it closed up near its high, which is not too bad. As I said, 6171 is the high and it closed at 6136. So I am still expecting 1 to 2 weeks down, and the more this thing goes up and the more vertical it is, the bigger the fall that's going to come back down into the low that I've been expecting. Because as you can see here, so we've got 1, 2, 3, 4, 5, 6 weeks up. 6 weeks up. If we go over this one here, we got 1, 2, 3, 4, 5, 6 weeks up. So we are expecting 1 to 2 weeks down. I would not expect a 7th week up because that just would then be pushing the envelope. The probability of it continuing to rise diminishes the higher it rises, if that makes sense. We do need to see markets go up in stairs, which means they move up, they come back down a bit, they move up, they come back down a bit, they move up, they come back down again. That's how it works. We don't see just continually rising, and so what we need to see right now is a move down. Now I did have my little tool on here last week, so let's whack it over there. You can see here that I'm expecting it to come down now. It should come down to around that 5.9, between that 5.825 and 5.906. So I do expect it to come down to that 6,000, below 6,000, get a couple of weeks down and then start to move back up again. But I think the All Ordinaries Index, that all-time high back in 2007, and I'm not on that, back here, right, where is it? 2007 all-time high, right here. I think that is in trouble for this year. I think we're going to break through that. So long term, I'm looking really, really good at the All Ordinaries Index. Now, let's go and have a look at some of the stocks that we've got. If I just get back in here, it's pretty powerful what the software that I'm actually using. A lot of people, they talk to me about platforms and broker platforms and how great they are. I don't use any broker platforms for doing any analysis on because I don't find any of them any good. So if I go around to, here's our first stock. Now let me bring up who's actually asked me that stock. I just got to get it up on here. Let me go back here. What do we got here? Okay, it's Goran. I can't say a surname Goran, so welcome to the channel, Goran. Thanks very much for giving us your suggestion. He says, hi Dale, thank you for your weekly report. My pleasure, matey. It's something I look forward to each Monday. Can you please give me your thoughts on Austral, or ASB is the stock ticker code. I don't own the stock, but have it on my watch list. Thanks, Goran. I asked Goran why he had it on his watch list, and he came back and said, after being told about the company, I had a look at the trend for past 3 months, which is pointing upwards. The company also released a statement regarding an increase in full year revenue guidance. I don't know a whole lot about the company except that they build ships, ferries, and have a few government contracts. Thanks, Dale. 3 months is not a trend. First thing is, 3 months can be a counter trend, so don't be fooled into that. And it's a big mistake a lot of traders actually make. They think a few weeks going up is a trend. It is not. It is a short-term movement in price, and Dow talks about them as secondary action, so you really need to be careful about what is a trend and what's not a trend. So we're looking here on the left-hand side of the screen. There's 1, 2, 3 months up, which is what Goran's actually talking about. Really what you've got here, Goran, the company's released a statement regarding full year guidance. Right now it is moving up. It's got an all-time high. If I look at its monthly chart here, you can see here its all-time high. It's breaking out. Where are we? Look at that. Huge resistance up around here. If I put around here, looking at the resistance around there. So if you look across to the right of that chart, you'll see there's a lot of resistance around that $2.14 mark. And in fact, the current month is still below it, as you can see there. If I bring it out over here, you can see here the close there is at $2.19. And it's struggling to get through that level. So right now it's not looking bad, but it's not looking brilliant in my book. We've seen 3 or 4 weeks up. I'd still be a bit cautious. I'd really want to see that it has broken out, but you'll probably see there if I go down onto the weekly chart, we're seeing last week, have a look at that, it opened on its high and it's closing below half of that bar. Now I'll talk about how to understand this and analyze this in our Trading Mentor course. So if you're really keen on understanding how markets and stocks move and how to buy, when to sell, get into the Trading Mentor course. It's seriously dirt cheap for what you actually get. But I'll explain what that actually means and what this type of bar actually means for you. But right now I'm saying that this bar or this market or this stock will probably drop away in the next 1 or 2 weeks. More than likely it'll come back into this sideways mess. In terms of price, if I just whack this little thing on here, you'll probably, oh sorry, I did the wrong thing there. Let me delete that. Where is it? Where's my little tool here? Nope, that's not the one I want. Okay, I can't see. Here we go, price range percent. So probably what we're going to see here is it's probably going to move back down to roughly around that where this 48.39% level is. It's risen that much since October, so it's risen pretty hard. So my guessing is it's probably going to come back under $2. That's what I'm thinking at this point in time. So thanks very much, Goran, for your comments here. Now keep scrolling down. The gentleman, if I don't say your name properly, please excuse me. I think it's Kaung. He says, hi Dale, thanks for sharing your expert knowledge. What do you think of Coles and Woolworths? Now Coles is interesting because it used to be under the stock ticker code of CGJ, so Coles Group Limited, and you can see there's this big warning signal here. That means that it's now changed its code or it's delisted off the exchange, etc., etc. Now Coles has changed its code because obviously the demerger that it had last year, basically. So we've been quoted under another code at this point in time. Why I've got this one up, because I will show you here. This is Coles right now. There's not a lot of data here, so we're looking at this first monthly bar here is November 2000. 2018, and it really doesn't tell you much. If I just looked at this, I'd be going, yeah, I wouldn't touch this stock at this point in time because it doesn't look that great. Based on what I'm seeing on the right-hand side, it looks more red. See all these red bars? It looks more bearish. Last week was bearish. It closed lower. It should drop down this week. But putting into context, Coles has been around in Australia for a long time, and we can see how bullish it was prior to this. That said, I think it's probably a little bit overdue for a pullback. See this vertical run that it had? I still think it's probably a bit more bearish at this point in time, so I'd stay right out of it. I really wouldn't be in it. I actually made that call last year, probably in October. I just said, you know, from a point of the demerger, I'd just say I'd stay right out of Coles. I'd rather be in Wesfarmers from that point of view. But right now, I can't see an upside on Coles at this point in time. Woolworths, bit of a different story. Have a look at that. It's looking really nice. It's trending really well on that monthly chart. It's got a bit of resistance here around that $30 mark, but should it break through that previous peak there at that 31.48, I think it's got more legs in it. It should be going quite well. Looking over at that weekly chart, we can see, I've gone a bit too far. It's looking nicely, a nice medium-term uptrend, so I don't have a problem with that stock at this point in time. It looks like it's going to continue to rise. So thanks very much. I won't say your name again, but please excuse me if I said it wrong the last time. Got one from Jerome. Jerome says, "Hi Dale, I'm new to the channel." Well, welcome Jerome. Thanks for coming to the channel, and I'm really learning quite a bit. Thank you very much. I've had Altium, ALU, the stock ticker code ALU, on my watch list for some time and have heard mixed things about the stock. I've been analysing the stock for about a month now, and it seemed to be progressively trending up. This has piqued my interest, but I'm not sure whether I should buy it or if I should hold off and wait. Pretty much, from an Altium point of view, if you're having a look at that, it's very vertical, and you can see that it's just taken off like a rocket. It's had a bit of consolidation here in the last few weeks. Right now, I think I'd sit back and wait. Again, have a look at this, 1, 2, 3, 4, 5, 6, 7 weeks up. I think it's going to come down. It hasn't proven that this low is the low. It hasn't proved it's in a new uptrend. It hasn't proved to me it's got enough strength to get through that point there, that 30.51. But anything that goes really vertical, it needs to have some sort of decent pullback. And this stuff I can't really explain for you right now, but I do talk about it, as I said, in my trading mentor course, and obviously in our flagship course, like our diploma, really teach you the bee's knees of everything you actually need to understand, how to trade and how to replace your income. But you really do need to watch this stock at this point in time. It wouldn't surprise me if, like the other stock we looked at before, ASB, if it didn't come right back down into this sort of sideways, around that $23 mark. I expect it to happen over the next couple of weeks to do that. After that, then have a look at it again, because if it does hold up quite well, then it may go on a nice run from there. But right now, I don't think there's enough legs in it at this point in time to get me too excited about it. So thanks, Jerome. Anyway, that was a really good stock to have a look at. Paul Sanderson. Hi, Paul. He says, "Hi, Dale. As a 19-year-old heavily interested in the stock market." I reckon that's fantastic. Not too many 19-year-olds are heavily interested in the stock market, so well done, matey. As a 19-year-old heavily interested in the stock market, I recently subscribed to your channel and purchased your book, and both have provided tremendous value to me. I'd just like to grab your thoughts on Aristocrat Leisure, as it has a high PE ratio, however a low dividend yield, whilst projections for its EPS increase each year. It also seems to have just come out of a downtrend and has begun to rise in the past month, and I have marked on my watch list. Low dividend yield doesn't bother me. Dividend yield is the least thing I look at. I'm after growth stocks. If you're after growth stocks, dividend yield should be completely irrelevant for you. Growth stocks generally have low dividend yields, like BHP, for example. It generally has low dividend yields because they use the money to increase their share price, basically. They're reinvesting back in the business, so don't worry about that. The more exciting thing to me is EPS increasing every single year. That's what I want to see, and that's what I teach our students. Look for growth stocks, look for EPS, because that's what you want to do. See, especially as a 19-year-old, you want your capital base to grow. When you're more in retirement, you're looking more for income streams, so dividend yield becomes a little bit more important. But if you're still in the growth phase, go for EPS, go for growth. That's what you want to do. Let's quickly just look at Aristocrat here, having a look at that, a big stock, and it's fallen quite heavily. At this point in time, I don't know whether it stopped falling at this point in time, and you can see a lot of indecision here. And again, I still think this stock's going to come down and test that low down there at that $21 mark, or whatever it is, at $20.66. It will be testing that. It still may fall a little bit further, but a little bit too early to get into this stock, but I would have this on my watch list. Okay, so let's get on to the next one. Actually, what I want to do is look at the banks really quickly before I finish off. So let's have a quick look at the banks. I've got the banks up on the screen right now. Westpac's in the top left, ANZ top right, NAB top bottom left, CommBank bottom right. Now, a lot of people are suggesting get into the banks now because they've fallen for 3-4 years. You know, the Royal Commission's finished, blah, 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 and let's get onto them. But have a look at these big things here. Big gap, big gap, big gap, no gap. CommBank's my preference. What's going to happen in general terms, you'll see all of those three that have big gaps in it, those gaps will fill. So generally what you'll see is the market will pull away, come back down and fill those gaps. Right now, as I said, the jury's still out on banks. I think, you know, part of me thinks that the big end of town have pushed the banks up to get people to, like the amateurs, I suppose, or what a better way of saying it, the uninformed or the uneducated jumping into banks thinking, wow, look, they're going up, they're really cheap, let's get into them. And they'll start selling into that extra buying that's coming in through the market. It did not surprise me at all last week. The banks moved up quite strongly. But it would not surprise me at all if this week or next week or over the next few weeks the banks start pulling back again to fill those gaps and start to fall away again. So right now, still too early for the banks for me. Let the dust settle. But my bank of choice, if you want a bank of choice right now, CommBank, that's the one I'm looking at this point in time, and I think it's the better of all of those big four. It's looking okay because you can see a couple of things is it's been trending for a lot longer and it's beautiful. There's no gaps in that, and look at the close last week, it's right on its high. So there's the sorts of stuff I teach traders to help them understand what stocks to pick and how to filter which stocks, like what should you be looking at. All too often people think it's just buy and sell rules, which is rubbish. Making money on the market is not about buy and sell rules. It's about the whole process that you take. Have you got the right process, the right structure? What kind of portfolio you want to do? How you're going to construct that? The buy and sell rules are the last things you start to look at on how you're buying and selling. And most people look at me and say, what's the best buy rule for stocks? And there is not one best buy rule for any stock. It's about what's your process, how you're going to do it. Because really it's about what you don't lose that determines how much you make. And really it's about having that proper strategy. So just briefly here, before I finish up, as I mentioned just before, we are doing some live testing this week. We will be launching the live show in a couple of weeks, so tell all your friends. Just briefly, somebody, just a new channel guy, a person on the channel called Robert, he says, that was a gentleman about the Labor government, what do I think about that? He also asked me about what do I think of Kogan. Retail is pretty tough at the moment. I don't like Kogan at this point in time. We're seeing tough. JB Hi-Fi is my preference in terms of retail stocks. It's one of the best retailers in Australia. It's looking good. Harvey Norman's also not looking too bad at all, but Kogan's under huge pressure with Alibaba being in Australia. So right now, I don't really like the look of Kogan. That's me wound up for today. But thanks for doing this and putting in recommendations and what you want me to look at. Again, subscribe now to the channel. Hit that subscribe button wherever it is. Also like the channel. Do that right now. That helps us. And if you want me to look at a stock or you got a question, please put a comment below. Happy to do it. So for now, goodbye, good luck, and good trading.